Are you struggling to pick the right strikes for your 0 DTE iron condor? In this video, I'll show you 3 simple, repeatable methods based on volatility, volume, and probability so you can trade with confidence. Let's dive in. What's an iron condor? In short, an iron condor is a neutral, short volatility option strategy designed to profit when price stays within a specific range. It's ideal for traders seeking consistent income without having to determine market direction. If you want a deeper dive in a full trade example, click the link in the description. There are 3 simple, repeatable ways to select strikes for a 0 DTE iron condor, and each one offers an edge. 1-day implied move, selecting strikes based on the expected daily volatility. 0 DTE options volume, selecting strikes based on high volumes. Options delta, selecting strikes based on delta probability. The first method is based on the 1-day implied move, also known as the 1 standard deviation range. This represents the expected price movement for the day, calculated using the Black-Scholes model from which options pricing is derived. Statistically, 68% of price action is expected to stay within this range, making it a great guide for placing your short strikes at or outside the edges of expected volatility. Sell a put credit spread at or near the implied low, and sell a call credit spread at or near the implied high. If you're a member, this data is available every morning within our daily market report, or you can obtain the 1-day implied move directly from the option chain, which is generally calculated by your broker. The second method is based on 0 DTE options volume, which identifies key short-term levels or zones by analyzing the most active strikes. The idea is that the highest volume strikes are where market participants expect price movement, reflecting key support and resistance levels for the day. By positioning your strikes around these levels, you're aligning with the consensus of short-term traders. Analyze 0 DTE options volume and determine the strikes with the highest call volumes and the strikes with the highest put volumes. The strike with the highest 0 DTE call volume is what we refer to as the max call. The strike with the highest 0 DTE put volume is referred to as the max put. If you're a member, this data is available directly within our Discord. It highlights key metrics and provides a visual chart. Not a member, no worries. You can still view this by analyzing the option chain on your broker. Keep in mind that options volume is dynamic, so these levels can change. However, trading range is generally established early in the morning, and shifting values can provide additional indications. If you want to learn more about this product, the link is in the description. So simply sell a put credit spread at or below the max put, or below another high volume put strike or zone, and sell a call credit spread at or above the max call, or another high call volume strike or zone. The third method involves using delta to select your strikes. Delta measures an option's sensitivity to the price movement of the underlying asset. It can help you position your strikes based on probability. Delta values range from 0 to 1 for calls and 0 to -1 for puts. A delta of 0.15, for example, suggests there is a 15% probability the option will close in the money at expiration. Or in the case of a credit spread, an 85% probability the option will expire worthless, letting you keep the premiums. Go to your option chain and sell a put credit spread with a delta of -10 to -25, and a call credit spread with a delta of 10 to 25. Keep in mind, there is no perfect delta to sell. It's a trade-off between risk-reward and probability. While these methods can improve your chances of a profitable trade, it's important to always adapt your strategy to the current market conditions and your personal risk tolerance. In the next video, we'll dive into how to manage risk on iron condors and what you can do instead of using a stop.